to understand what has happened with M&A over the last 6 months and what might happen in the next 6 months. We got to understand what is happening in the environment around us, which includes the freight market and the economy at large. To unpack it all with me in this mid-year report, two living legends. First, Jonathan Stark, CEO and CIO at FTR Transportation Intelligence, and also the Jason Miller, professor in supply chain management at Michigan State University's Eli Broad College of Business. Gentlemen, thanks for being here. If you would, Jonathan, just give us 20 seconds, a little bit of an overview of the work that you're doing at your organization there.
Well, FTR stands for Freight Transportation Research. Our goal is to help people understand what's impacting the market, whether we're talking carload, intermodal, truckload, LTL, all the aspects of what's happening within the transportation space, specifically focusing in the North American marketplace and making sure people have broad understanding of what's happening in the economy, how's that driving transportation demand, what does that mean for capacity and rates.
I love it. Jason.
So I am a research professor here at Michigan State. A lot of my work focuses on the intersection of supply chain management and economics. Much of that is tied to the freight markets, but also getting a little bit broader: manufacturing, wholesale and retail, trade data, and increasingly as well, again, inflation.
Perfect. Thank you, gentlemen, in advance for the insights that are going to come from this. I know this is going to help a lot of folks as they try to make sense of how they will use M&A as a strategy in the second half and beyond. Let me jump in here. I'll offer a couple hot takes from some industry contemporaries, and we'll get your response to that. Jason, we'll start with you. Actually, Jonathan, let me start with you. Dean Croak, principal analyst at DAT Freight and Analytics, recently said this isn't a demand story yet, it's a supply story. Where's Dean right? Where's Dean wrong? What would you say?
He's right. So far, it's all been about what's happening with supply, and that's from the enforcement side coming from the government, but then also just the natural attrition and tightening that's been happening over the last 3 or 4 years. We're still waiting to see, can we get a broader demand environment going? And I think me and Jason will have a good discussion about kind of where we're at right now, where that could be happening. But up to this stage, it's really been focused on capacity.
So let me throw it to you, Jason. Craig Fuller, founder and CEO at Sonar and Freightways, recently highlighted strong manufacturing activity and rising tender rejections as evidence of a strengthening freight market. Where is he right? Where might that be a little short-sighted?
So we've seen strengths in subsectors of manufacturing, and it's essentially everything tied to the AI ecosystem boom. So the build out of, construction steel, large batteries for power, large generators and things like that, switch gear, electrical controls, transformers. That freight is doing very well right now, and it's very flatbed centric. And so when we look across the different verticals, flatbed is most of the demand story of the sort of three key verticals that we tend to think about. On the other hand, though, you're seeing substantial weakness in anything tied to the housing market and discretionary consumer spending. So furniture manufacturing's down, household appliance manufacturing's down. Motor vehicles and parts isn't doing that great at the moment. And so this is not a broad-based manufacturing boom like we saw in 2017 or 2018, when essentially every vertical was doing better. Here it's very uneven.
So let me camp out there for 1 second. So what does that mean? Because it's not a broad trend, how could that affect the way that carriers and freight brokerages plan for growth or lack thereof in the back half and beyond?
So I think let me put a couple of highlights, and then we'll let Jason kind of go off from it.
I like it.
It is important to really focus on the manufacturing and industrial environment. We are, clearly a service and a consumer-oriented economy, but when it comes to transportation demand, the manufacturing environment is what really creates the demand for transportation of goods. And so understanding where and how that growth is developing is critically important. And Jason highlighted, a few key aspects of that. A lot of the growth is in high value stuff, pharmaceuticals, computing. Some of the offshoots then for AI are positive, especially for things like flatbed. But we had a very flat consumption goods for the consumer in Q1, right? We're just not seeing growth in that environment at the moment. So we're not getting the consumer necessarily involved. We're having some growth, but it's still very modest growth in sort of the broader elements of what the manufacturing environment is looking like.
Yeah, Jason, kind of build on that, please.
Yeah, no, I think that, again, roughly 60% of freight, at least moved by for-hire trucking companies, originates in manufacturing. The key thing then is a lot of that is very minimal cyclicality. So food, beverage in general, sort of fairly smooth from a long-term trend line standpoint. We have seen a lot of weakness in beverage over the last couple of years with consumers dialing down some of that discretionary spending. And so that's where we look, very closely at that. And, we've seen some positive new order momentum. ISM's data has been, more modest. The Federal Reserve Banks has been a little stronger, but it's still a modest growth. And so one of the challenges that's being created by having certain verticals doing well compared to others is you're getting, for example, with data center construction, a tremendous amount of project freight. And that can be very challenging from a brokerage standpoint because you may be tendering 40 or 50 loads a day to a large data center site. Well, carriers, one, figure that out if they don't already know, hey, this is all going to a data center. And so they start bidding, as the day goes on, your rates are going to go up that you're paying as a broker because the carriers know the capacity is getting all sucked away. And so what you're getting right now is imbalances are being created because you've got a ton of freight, for example, going into the Stargate data center down in Abilene, Texas. That's going to cost a broker a lot if you are servicing that market. For asset-based providers, project freight can be a challenge because, again, your equipment starts getting out of position. If you've negotiated a fixed rate on that, it can be challenging. You may accept up to, the given level. Then you may start to reject some of it. And so I think the nature of that, sort of explosions of certain freight pockets is very challenging. It almost reminds me of a much larger scale phenomena that happened at the early onset of the COVID pandemic where everybody ran the grocery stores dry. There was this huge surge of replenishment orders and actually tender rejection shot through the roof in mid-March. And then once that demand, everything was replenished and we put the economy in lockdown, everything plummeted. This is just a much larger scale, certain sectors growing well, others not. It also kind of feels a little bit like when we reopened the economy kind of around June of 2020, where, Home Depot was, selling 15% more stuff. Carriers are overwhelmed servicing their stores, whereas steel production was still down 15% from 2019. So the flatbed carriers hauling construction steel, didn't have much to do. And can you reposition that equipment? That isn't an easy story necessarily.
No, there's a lot of nuance here. So before we go any further, there's several things to unpack in terms of geopolitical things. We've got, inflation reports coming out this last week. We've got, reports on the freight market at large that we're probably going to discuss. But before we kind of get to today, Jonathan, can you give us just kind of some context? Where are we and how did we get there? Kind of backing up, we've got, call it 4 or 5 very different freight markets going back into 2021, severe challenges over that period of time. But maybe just give a little context for the rest of our conversation. Where are we? How did we get here?
So obviously, we came through a very disrupted period of time, all the way from 2020 into 2022. And the overall economy had to find its footing, and that took longer than normal, right? Usually it comes down, it figures out, it finds its footing, comes back up. But because it was so disrupted, we didn't have sort of that normal cyclical environment. And so we just sort of, from the freight perspective, just had this very subdued environment. It really never got extremely weak from a demand perspective, All right. But what we had was a lack of growth. And so the fact that there was a lack of growth meant that the market was repricing at a very low level. If you looked at where pricing should have moved, right? If pricing purely moved on analytics, pricing should have started moving up, in 2024 into 2025, moving, slowly and steadily. Pricing doesn't move slowly and steadily. All right. It's much more of a psychological event, right? Where the pressures build and then they hit and disrupt the market. And that's why we had such a big disruption in pricing that occurred in January, February, because you had all that buildup that had occurred over a period of time finally got vented all the way through the marketplace. And we're still disrupted. I think there's an important point Jason brought up earlier about productivity in the marketplace, right? When you have pockets of strength, that means there's a lot of pressure to move stuff in, but now you don't have the normal backhaul to reposition your equipment. So now you're going, longer empty miles. So that means you need more price in order to move that freight, right? That's one of the things why you see that sort of continual upward pressure on pricing for the flatbed is because it's very disrupted. They don't have the normal flows. We don't have the broader environment pushing up volumes in other areas. And so that means that pricing becomes the lever to really move the market. That's where we sit right now. Right.
Well,
let me.
The
question becomes, what comes next?
Well, let me tag Jason in there. So looking back, he kind of got us through 2020, 2024, and a little bit coming into this present year. Looking back at 2025, Jason, what do you see as the most important freight market trend that shaped the first half of 2026 in a major way?
Yeah, so looking at 2025, the key thing to remember was outside of December of 2025, 2025 was a bad year for carriers. And so you had a lot of optimism at the start of the year. And then you had the tariff uncertainty. And probably the bigger effect of the tariffs as they were ultimately implemented in 25 was the uncertainty around it, because there are carve-outs big enough to drive a proverbial semi-truck through. And so the tariffs never approached sort of the cataclysmic levels that we were being told they were going to approach. It never got anywhere near the actual Liberation Day levels, as an example. But what that did is it put a lot of CapEx on pause. Companies didn't buy as much machinery. And you also had a lot of carriers that entered 2025 saying, this is the year it's going to turn. We're darn near failure, but we're going to keep going because we think that this is the year. Well, it didn't turn out to be the year. So you had this steady loss of capacity through the year. You have September, you start having enhanced enforcement English language proficiency, which didn't so much affect the pure number of drivers as it did, hey, I don't want to drive into this area. This carrier decides not to serve this lane, etc. And it does remove some capacity, but it's not much. You then have the non-domiciled CDL uncertainty. Again, it's chipping away more capacity. And so you had capacity steadily exiting throughout the year. My hunch is once we get the administrative records, we're going to find there was a much bigger drop from December into January. So within trucking, a lot of firms will exit, moving from essentially after Christmas, they will bail and basically close up shop and be done for that next year. We can observe that in the administrative records. And so I think you probably entered 26 with this another big drop of capacity, with folks saying, okay, with the non-domiciled stuff, we're out. 2025 was a bad year. We're just not making enough money. And so we entered 2026 with capacity finally falling too much. And then you've also had, again, if you look at the AI ecosystem data, the imports of GPUs, computers, the construction spending on data centers, it is data that was progressing up in 25, but it's now exponentiating up in 26. And so you've had too much capacity leave, both due to regulatory enforcement and just organic, loss, as Jonathan talked about. And so you've sort of tipped over that threshold, and you now have it meeting some very strong positive pockets of demand, and you've had rates shoot up. And then let's not forget, we just had the Montgomery ruling, which has really thrown things for a curveball for brokers, because you actually saw the market. It was really tight January and February. Some of that was weather. Tight in March, that's into quarter loading. But Jonathan, correct me if I'm wrong, it started to ease a little bit in April. Rates were still kind of strong, but it was starting to ease when you looked at load to truck ratios and things like that. And then we hit mid-May, we hit road check week, and then we had the Montgomery ruling right at the end of road check. And it really, really, really tightened in May. We're in June. It's going to be a great month. June's always one of the best months of the year for carriers, from a pure demand standpoint, as well as pricing, end of quarter loading, 4th of July. We probably have some oddities in here of the World Cup excitement and the freight that has to be positioned for that. That's probably going to be a little bit more of a boost. And so we're poised to enter the second half of the year on very good pricing terms. But as you alluded to, Spencer, the challenge is there's some big macroeconomic forces that are very difficult to forecast that could shape the back half of the year in different directions, depending on how.
So let's unpack that a little bit, Jonathan, in terms of these macro issues, as if we needed more disruption. But let's talk about the possibility of some of those things in the back half and what we should keep our eye on.
I don't think you can keep your eye on, overall GDP and have that really give you a good understanding of what's going on. Because, we grew, around 2% or so the last year plus, and we'll probably grow around 2% or so the next year. And so I don't think GDP is going to give us a good framework for understanding, right? So we really need to understand what's driving the equipment environment for investment. Is there a potential to see either residential or, non-residential structures really start to see some type of positive benefit? And can we get that manufacturing, those green shoots to spread, become more dispersed, and continue to grow? There's possibilities in all of those things happening, but I also struggle to see all of them being able to happen at the same time. So I still think it's going to be continued pockets of strength that shoot up and are positive and continue to increase over time. But I don't see anything really leading to like this real strong explosion of demand that will keep us, sitting at very tight capacity going through the balance of 2026. It's a possibility, and it's something to kind of be prepared and vet, but that does not seem to be where we're sitting at the moment.
Think of that, Jason. One of the qualities of your research that I appreciate most is that when the narrative gets a little bit too rosy, you're always really good about not so fast. Here, the devil's in the details, and here's a few things that we might be missing as an industry to keep our eye on. So, what are some things that maybe are not as readily studied or brought to the forefront that you see as problematic, or it could be a good thing that we're not really that focused on as we enter the second half?
Yeah, so I think, and Jonathan hinted at this, but and to give FTR a shout out for the quality of the Class 8 truck order data. It's one of the most useful indicators to get a sense where capacity's at. We are seeing a return to the classic market dynamics of spot rates go up year over year, truck orders go up year over year, and it's almost a 1-to-1 relationship. And so right now we have new Class 8 orders are more than double where they were last year at this time. Caveats being we have regulatory clarity from the EPA. Last year at this time, we also were at sort of peak tariff policy uncertainty. And what does anybody do when there's uncertainty? We don't do CapEx. That's hard to reverse. And so those things in mind, equipment orders right now are way beyond replacement level. They are in strongly, solidly expansion territory from a capacity standpoint. Challenge is that capacity takes 9 months to a year to really start to come online. And so the concern is as Jonathan mentioned, an index I published through Standard & Poor's, the Trucking 10-Mile Index, we only have activity and demand for trucking up about 0.3 to 0.5% from last year. That is very weak growth compared to 2018 when we were up 3.5%. So demand growth is basically 1/7 of what it was in 2018. So we've had all this sort of supply side pressure pushing up rates. But the problem is supply is, as we'd say in economics, is super price elastic. Freight rates go up, carriers add capacity, albeit with a 9-month to a year lag. There's a strong, what I'd call expansion drive amongst operators in the industry. Folks want to grow their carriers on average. And so the challenge is going to be, we are going to have capacity start to come online Q4 of this year into 2027. New folks will say, where are you going to find drivers? It's very simple. It's like every labor market. People transition into trucking from other occupations. We know this from BLS research. There will be carriers going out of business whose drivers look for employment elsewhere, and they will shift to a different carrier. That happens all the time. And so we know capacity will start coming online in a few months. It's not going to be the type of capacity growth we saw in 2022 or likely even the back half of 2018, 2019, but it will be some capacity. The question then is, if demand doesn't start growing more rapidly, you'll start to see the market cool as that capacity comes online. Jonathan mentioned, residential construction. This is a sector since about the third quarter of 2022 that is just stuck in a rut. Existing single-family home sales have basically not really budged, and they're about 30% below pre-COVID levels. Single-family starts have been doing fairly strong. They're around 2019 levels, but they look nothing like 2021. And the challenge is now is we're in an environment where everybody entered 2026 anticipating at least 50 basis points of interest rate cuts. And now we're in 2026 where the base case for the market is 25 basis points of interest rate hikes. But based on the inflation data we're seeing, especially more on the producer side, I would argue that it's actually potentially 50 basis points of interest rate hikes. And unfortunately for the trucking sector, because so much freight is sort of the cyclical capital investment type, if the Fed raises interest rates, that will quickly cool demand. We saw that in Q4 of 18 into Q1 of 19. We saw that starting late Q2 of 2022. The Fed is what put the 2021-2022 bull market to bed, more so than the capacity gain. They put interest rates through the roof, and investment collapsed basically by the back half of that year.
Yeah, and obviously we saw that up close and personal. I'm curious about this because what we see.
Let me say something about the driver environment, because I think
go
it's
ahead.
really, really important, because this is the key issue of whether the industry can grow successfully going into 2027. All right. What I would put sort of drivers into kind of three buckets, right? Those who aren't actively in the market. They're sort of the marginal driver. Another one that kind of goes in and out really readily, right? They don't have some other sort of normative position, occupation that they're fully engaged in, all right? A lot of those were, the immigrant workforce, right? They go in and out of those occupations very, very quickly, all right? The next one is a more standard position, right? Somebody who's maybe working construction and now has been doing it for a couple of years. They've driven before in the past. They could come back into that market, but how likely are they? They're a less likely opportunity right now if they have opportunity within some other vocation, right? And then the third one is creating new driver pool, right? That's the one that always comes to the top when you get into a very critically tight market, which we're approaching, right? But it's also the hardest one. It takes the most recruitment, it takes the most time, energy, and effort, all right? So if you don't stay at a sustained tight market for a good period of time, 6 to 9 months, there's not enough pressure to pull those new people in the market. We're limiting the ability for those marginal people. I think it's hard for the standard drivers who have a new occupation to come back in. So I think there are some clear limitations that are built in for bringing those drivers back into the market. Not that they can't, but that pricing mechanism has to be strong enough and sustained long enough for that to truly be effective.
Anything to add to that, Jason?
No, I would agree. And that's where, historically bull market pricing cycles, if you look at 17 into 18, my argument is always that market flipped in June of 17. And you can argue it flipped back in either October of 18 on a seasonally adjusted basis or January of 19. So if you do that, it's like, 19-month expansionary market cycle. If you look in 21 or 2020 through 22, it flipped in June into July, and then it flipped back between March and April of 22. So that's like a 21-month cycle. We're right now in month 6.5 or so of the current cycle. So per Jonathan's comment, we're starting to get to that point where people fundamentally interested in joining the industry will come about. And the one thing, there's two great papers that look at where people enter trucking from. And a lot of it is not necessarily what we even expect. It's people in management occupations who lose their job and decide, hey, I'm going to do something completely different. It's people working in a warehouse. They interact with truck drivers a lot and they think, hey, this seems better than sitting over here with, the eye of the supervisor on me all the time. And so the problem is it takes time for individuals to decide to switch occupations. And so this is why supply always lags the market. And so I do think we're probably in this cycle now long enough that we will start to see that. And this is always one of the reasons I'm always cautious of when I start seeing headlines of like, incredible conditions ahead. It's going to be a perpetual, expansionary market or anything of that sort, because that's actually the type of language that has people saying, you know what, I think I'm going to become a truck driver. And that was what we saw in 2021. That was all the language. I remember CNN doing, we're short 80,000 drivers and talking to all these folks who are just entering the sector. And it's like 1 year later, rates are crashing down. And so I think we will start to see that. But, like I mentioned, it's going to be, I believe, a slower recovery for employment as that starts to happen and capacity than what we've seen the last couple cycles. If it is not, if somehow capacity comes back on, kind of at the same rates that it did in 13 and 14 as that market improved, then I think we'll all be sort of checking our assumptions on, hey, maybe more people will get into trucking if the market seems like it's strong. And so we're kind of living another natural experiment on this front.
Very interesting insights. Let me transition. Jason, you mentioned just inflation. There's a variety of factors that are affecting that right now. Give us a little insight into the most recent report that we talked about offline, and what does that mean for trucking in the back half?
Yeah, so if we look right now, the inflation data, I tend to focus a little bit more on the producer price indices. These measure sort of the price changes businesses are experiencing. We just had the data released for May, and that is a report that sort of has some troubling signs, because what we're seeing is the sort of pressures are building fairly far up within the supply chain in things now like industrial chemicals, plastic and rubber products. Aluminum prices are through the roof right now, no pun intended. And what that means is that's going to be pressure coming down to ultimate end, what we call final demand firms making stuff that consumers buy, or firms making stuff that goes in to capital investment. And so that's going to put pressure on that ecosystem. That's what the Fed looks at to try to think about raising interest rates. And so, as I'm seeing the inflation data right now, what I'm starting to see is, okay, what happens to demand in the trucking space if the Fed says we need to get inflation under control, and the only tool we have to do that is to raise interest rates? We actually just today saw the European Central Bank raise interest rates by 25 basis points to try to get ahead of what they're seeing in Europe's data. And Europe's data actually doesn't look as rough as our data does from an inflationary standpoint. And so the concern is Fed raising rates would be very bad for trucking demand. What we're seeing too with all the data is the cost of operating a carrier is not coming down. right now anytime soon. It is going to be high. And then, of course, the biggest question is where does the Iran war take us over the next 2 months? Bloomberg just had a great piece talking about why oil prices aren't higher than what they are. And the one factor that hasn't received much discussion is China has reduced their oil imports by 40%. And we're not sure completely what is driving all of that. Is it drawing down some inventory, reducing refinery runs, and therefore using their inventories of finished product? Is it the petrochemical complex transitioning more to coal, limited exports, probably some factor of all the above? But the question then is, from a broad inflationary standpoint, is when does China come back on the market? Because they're not removing 40% of their oil consumption in perpetuity. This has got a lifespan. And so what we're having to figure out is where do things go the second half of the year? My biggest concern for the trucking sector is if something happens and let's say China starts buying again, U.S. exports start being limited because our inventories get too low, and it's not even an export ban, but it's just the physical system won't support it anymore. And the war goes hot again. There's some long-term infrastructure damage in addition to what's already taken place. If oil goes to 150 or 160 a barrel, I don't see how the U.S. consumer can keep going at this point in time. When you look at where the credit card delinquency data is, when the auto loan delinquency data is, because unfortunately, even though inflation today is much lower than 2022, the consumer was in a phenomenal position in 2022 to weather that. The job market was ridiculously strong. Wage growth was very strong, and people had a lot of COVID cash saved up. Job market today is not great, especially the hiring rate. Wage growth is well below what inflation is, and people have a lot of debt that is becoming more and more seriously delinquent. So that's the biggest concern on the back half of the year is energy price shock and or Fed raising interest rates really cools demand. And therefore that will bring trucking rates down, certainly on a line haul basis.
So let me add two pieces to what Jason said. I completely agree with the oil shock scenario. And I agree that it's probably, if there's no resolution within the next 4 to 6 weeks, then we probably start seeing some really critical things begin to happen. This isn't we hold off until October and we'll be fine. It's something that's going to be much more near-term oriented, but the shock will persist well through the end of the year. The other one is looking at sort of the inflationary environment. If I think about the shipper's perspective, usually, right, they're dealing with inflationary pressures when they have a lot of demand, right? So they're looking to ship more goods, all right? And they are shipping some more goods right now, but most of them aren't shipping a lot more goods. But they're still getting hit with lots of inflationary pressures. You know, transportation's one of them. Energy is one of them. Metals is one of them. All right. And so they're getting negative shocks without the benefit of the positive shocks that usually associate with it. All right. So that's raising the risk for entering some type of a stagflationary environment. Right. It's not necessarily that I think that the overall economy is heading towards there, but there are portions of the economy that are getting hit with lots of heavy cost increases, but aren't seeing the commensurate increases in demand for goods that would offset that impact.
No, that's fascinating. You know, you kind of alluded to this a moment ago. We talk about CapEx, and there's been a lot of folks that for a couple of years now, there's been some significant deferred CapEx as far as capital commitments, and we see that at the M&A table, and we have to account for that in some form or fashion. But I'm curious, how do you see other operators thinking about capital commitments? They can't really continue to punt down the road, but we're not really yet into a place where, you know, the market is giving them that much more comfort based on what's up ahead. So what advice would you guys give as you look to these things? It's kind of a damned if you do, damned if you don't. in terms of making these kind of capital investments, but possible interest rates, cost of equipment going up, everything's going up. But if they don't do anything, their maintenance costs explode. So, given the environment and kind of the things that you see coming up the pike, what advice would you give to folks that are trying to process very important capital decisions?
So in 2025, clearly everybody paused, right? That's what happened. We saw it getting reflected in a number of different ways. And just looking at the amount of volume that the transportation companies were dealing with was a clear example of that. In 2026, all right, we're getting away from the pause, all right, but we're replacing, we're replenishing, we're doing the things we need to do, all right, but it's very limited as to those who are looking to actively engage on increasing their capital spend, their capital environment going forward.
Right.
We are seeing it in a few areas, a few realms in which the administration's whole point was to try to push towards domestic sourcing, right? And there are pockets of strength in which we see that happening in the metals markets. A big trailer manufacturer really pushing to reintroduce some domestic production for them. All right. So there's these pockets of strength, but they're not enough necessarily to fully offset the fact that we're getting back to replacement, but there's still limitations on the ability to actively grow the investment specifically for capital and equipment. And that is what the transportation markets really rely on for growth.
Yeah, I think what's interesting, we've heard, I'm interested in your take on this. We've heard from a number of different people, even through, Scopolitas and True North, working closely with independent contractors. And I think there's an expectation that depending on what any type of demand growth comes, there's a large swath of carriers that expect to lean hard on independent operators for that growth rather than investing in more fleet because of, how they got their hand popped at some point in the last decade about going too strong and being a little too bullish when there wasn't enough runway on that demand trend. And so I'm just kind of curious, what do you see as some possibilities as how carriers might respond to, some type of demand spike without knowing how long that's going to last?
Yeah, so we know from economics research that firms really are hesitant to make what we call hard to reverse investments. And the examples would be adding more capacity beyond what sort of your current level of demand is, or expanding payrolls beyond what they currently are. Firms are very hesitant to do that unless they have a very good sense that any type of increase in demand is going to be there for some type of sort of extended period. When we look at something like the data center build out, there's a lot of uncertainty about how much additional demand there will be. These projects are completed in a certain area. You're a carrier that's operating in that area. Let's say it's Texas. Well, it doesn't help you if there's a data center being built in Wisconsin, right? So you have sort of that dynamic. I think, where the challenge where some asset-based providers will find themselves in is, let's say you got 35 trucks, you're servicing a shipper, they're starting to see increased demand. Let's say they're tied to the data center boom. You've still got to provide a given 95% service level if you want to keep that business, especially anytime the market weakens.
Yeah.
And so look, if they were giving you 15 tenders a week and they're now saying, hey, this is going to increase to 20, we want you to have this. You either have to intentionally lose market share, which that is dangerous because if you let somebody else get some of those loads, there's a very good chance that operator says, yeah, I'll take more from you. And guess what? You lose the account. So you either have to allocate more of your fleet to that. That creates challenges because that's now 20 loads a week running a certain lane. You probably don't have 20 backhauls out of that destination. So you got to find more business there. Or you say, you know what? Okay, I'm just going to expand my fleet, try to do that and try to go about it this way. And so this is where there's, I think, a lot of carriers that are not able to provide their shippers the acceptable level of service. They will feel pressure to grow. because the concern is always if you're not providing an acceptable enough level of service on the, Jonathan, haven't seen what the latest estimate is, so I'm just going to say 80% of freight that is contract between shipper to carrier roughly. If that market, if you're not providing acceptable service, you run the risk that the next negotiation, whether that's annual, whether that's 6 months, you lose the business. And so I think that carriers, as this tightness has extended, it will be harder to not expand if you've got accounts that are doing well.
Yeah.
And I think that that's where as well, I always like to think the investment that was paused last year was a lot of the expansionary investment. If it was replacing a beat up machine, well, you're going to do that regardless, because that's not that's not a hard to reverse investment, because it's just replacing capacity that already existed. And so there's likely been some pent up demand this year. But then again, the biggest thing that I'm watching as well, other than where do energy prices go and inflation, is what's going on in the AI ecosystem, because we have an incredible amount of capital being poured into this ecosystem. We have not seen a build out like this since the fracking boom of 2010 through 2014. So basically this is fracking 2.0 from a freight demand standpoint. That was phenomenal for carriers operating in the Dakotas, Colorado, Permian Basin, Texas, until 2015, when the fracking bubble popped. And I think that lesson is going to, sort of loom large, because make no mistake, if we would have, for some reason, the stock market wakes up 2 months from now and says, okay, all this AI investment is just not worth it, crushes all these companies' stocks, and we start to see data center investment get pulled back on, you're going to have an economy-wide recession. I mean, because that's how dependent the entire country has become on this ecosystem build out.
Wow.
And so I think that's one that's making it harder from a carrier decision-making standpoint, because in 2017, 2018, you could look out and see we got good runway, especially in 2017, you could look out and say, man, we got great runway to grow. 2021, it felt like the money was never going to stop flowing until it did in 22. Now it's different. And even with tighter capacity, Jonathan, again, correct me if I'm wrong on this, but if you look at tender rejection data from FreightWaves, flatbed's astronomically high, but dry van is way below where it was in 18 or 21. So it's very much that flatbed piece is the really ridiculously tight piece. The other pieces are tight, but from just finding capacity basis, right now, 2026 is not as bad as the first half of 2018 was, where you just could not find trucks because demand was growing so much.
Yep.
Yeah, maybe you respond to that, and I think just kind of bringing into the response, we talked offline about highest freight rates on record, undisputed, and so contextualize that for us, while kind of responding to what Jason just said there.
Yeah, so we look at the overall spot market to be up something like 30% this year versus last year. All right. And that's on a percentage basis, not quite as strong as it was growing back in 2021. But that's a very robust environment. But what we had from mid 2020 through sometime in early 2022, you had that really extended run up. All right. We don't have that extended run up yet, right? Rates flatten out very quickly here later this year. And so you don't have that type of consistent pressure growing in the market. But I wanted to say one thing about, bringing capacity into the market. There's a very big difference between what fleets were going through in 2022 versus what they're preparing and doing in 2026, right? In 2022, they were coming off the pressures that built throughout 2021. They had ramped up recruiting. They were actively trying to grow their fleets quickly and rapidly. And then you had the diesel price surge, right, in February of 2022. And that took a whole slew of that owner operator capacity and pushed them right into the fleets. All right. And so they were able to boom, jump and grow their fleets rapidly, quickly at the absolute worst time. Right. Just as the dynamics of what was needed from them was going down. So they've lived through that pressure. They haven't felt, a year and a half of pressure yet, right? So they don't have that. They haven't ramped up the recruitment environment. They don't have the demand pressures, right? There's still need for them to increase their environment. They don't have the same level of demand pressures. So I think they're going to be slower, right, to increase their employment and their overall capacity availability, right? They're going to grow it, but I think it's going to be in a more constrained fashion versus what we saw then, right? So that means, if you kind of say, all right, they're the biggest chunk of the market, that means that the capacity environment is likely to grow slower as well, right? And so that could help keep the pressure on the market, to keep rates a little more elevated, to keep it tighter going forward into 2027. Because I just think they're operating from a different perspective going through this year than say 4 years ago.
I think that's a good word right there. Let me transition and kind of bring M&A back in, a couple more thoughts, and we'll kind of put a bow on this. Most folks that specialize in M&A in this space recognize that there's a large amount of inventory of companies that would have been available to purchase over the last 3 years, but just the environment did not lend itself. They self-elected out. They did not get into that environment to exit. And in the M&A world, we don't need perfect conditions to have a significant amount of M&A activity. We just need stable conditions, and we just really haven't had a consistent or long enough period for a lot of this inventory to go to market and then execute on deals. So my question is this, gentlemen: what are the factors that you see that could help stabilize the market so investors could get more comfortable over the next 12 to 18 months and do some interesting things from an M&A standpoint?
War in Iran has to get figured out. That's the biggest factor in my mind. And then two, because that'll affect the interest rate conversation. And then two is trade policy stability of some degree or another. We're now hearing conversations that the Trump administration may not renew USMCA, which would put things on a yearly, renewal and agreement. Oh, that is not what manufacturers want for North America, because that level of instability, I hate to say it, I'm just going to import it from Asia at this point. I'm going to import it from the EU. And so we need stability. And we need stability geopolitically. We need stability on our trade policy.
Jonathan, what would you add or subtract?
So Jason kind of pointed out the macro. I'll kind of focus a little bit more on the micro then. And I would probably say the primary thing looking at those individual companies is what is margin and net income, right? Because, going through 24 and 25, net income was at best very close to flat. And for many people, it was worse than that, right? And so it's very hard to get an appropriate valuation when you're going through an extended period of time and you don't have the net income showing up on the balance sheet. Even if, you've got good cash flow or you've got sustainable operations, et cetera, you still need the net income to show up in order to create the environment you really want for that M&A activity, I would assume. And so going through, especially Q2, right? We saw the ramp up in rates. What's going to be the ramp up in their costs, right? Is it going to be commensurate and they're only able to marginally get better margins and income into the system? Or are they able to get it down to the bottom line in some substantive form?
Yeah. And I think some might conclude, as they have in the past, that you can only squeeze so many pennies out of a dollar. At some point, you got to change the formula for how you create profitability in this space. And so, and that's where M&A comes in. Hey, one last thought, and we'll wrap it up here. Jason, we'll start with you. What is one positive thing that you're excited about as you get into the back half of 2026 that our listeners can look forward to?
No, I think overall, from a carrier standpoint, you've got enough of a running room because rates are as high as they are. Certainly through Q3, you're going to have a great rate environment. Q4, again, gets a little bit more murky because we just don't know where everything is going to turn itself out to be. But, July is going to be a great rate environment. August is going to probably be very strong as well. And so, there's probably going to be some incremental demand pick up here in June because of that World Cup activity. There's going to, even though we think of it as services, that's still got more people in the country. That's generating more freight. They're eating more food, et cetera, et cetera. And so, there's a lot of positives here in the near term. Data center construction ain't slowing down anytime soon. So market's going to stay very strong through Q3. And then pick your geopolitical outcome. We'll see where Q4 is at, likely still to be strong. 2025 or 2027 is the one where forecasting is, much murkier.
All right, Jonathan, wrap it up for us.
I mean, Jason kind of hit on several of the key points. And if I was looking for where the positives are going to come from, I'd really be looking at, and those green shoots in manufacturing begin to grow and expand into other areas. Because again, anytime you can increase one manufacturing output, you're increasing your transportation output by, some X factor bigger than that. And so it has these compounding effects. So if we can start seeing something better than, 2-3% growth in industrial production, and in the manufacturing environment, that really can lead to some good, profound activity throughout the transportation space. And I think it helps the overall productivity, right? As we get more areas of the industry involved, reducing those deadhead miles, making a more productive driver. And I think that's beneficial for shippers. It's beneficial for carriers. It can even be beneficial for drivers. So it has positive aspects that kind of compound through the system.
I love it. Hey, thank you both so much for sharing your time with us. Again, I just want to pound this in. If you want to be effective in the world of M&A, you got to understand what's going on around you. And if you're not already following Jason and Jonathan, get to it, because they are tremendous resources to help guide you as you make sense of this crazy world around us. Enjoy the rest of our mid-year M&A report. We'll see you next time.